For generations, we've all been told the same thing, right? The American dream is built on owning a home. It's supposed to be the best, safest investment you'll ever make. But what if that cornerstone of wealth, that foundational belief, is actually a multi-trillion-dollar trap? Well, to figure that out, we've got to listen to what some of the world's sharpest investors have been trying to tell us for years.
Wow, that's a pretty bold statement. It just cuts against everything we've ever been taught. So to really get why they say this, we first need to get on the same page and completely redefine our financial vocabulary.
So, how in the world can a house, something that's obviously so valuable, be a liability? Well, it all boils down to one simple thing. Which way is the money flowing? First, let's agree on what an asset really is.
Financial experts like Robert Kiyosaki make it this simple. An asset pays you, a liability costs you. You know, it's an almost painfully simple framework, but it's incredibly powerful. So, with these definitions locked in, let's take a hard look at your primary home.
And this is where the picture gets crystal clear. A true asset, think a rental property or stocks that pay you dividends, it generates income. Money flows in. But your main home? Oh, it's a constant drain. You've got mortgage interest, property taxes, insurance, repairs. I mean, the list just goes on and on. The cash flow is only ever moving in one direction, straight out of your pocket.
And here's the crucial part. Every single dollar you pour into your house is a dollar that isn't working for you somewhere else. All that money tied up in your down payment and all those ongoing expenses, it's money that's been yanked out of what we could call the compounding machine, the stock market, where it could be growing for you. Your house becomes this financial black hole.
And hey, if you think this is just some fringe idea, get this. Even the world's greatest investor, Warren Buffett, fell into this trap. And his story, it's a really powerful lesson for all of us.
So back in 1958, Buffett bought his home in Omaha for just over $31,000. And yeah, he still lives there today. It's a famous symbol of his frugality. But from a pure numbers perspective, he had a very different name for this purchase.
He called it Buffett's Folly. Why? Because the man is a mathematician at heart. He knew that the 31 grand he sank into that house could have been earning him way, way more if he'd just invested it. That capital was basically frozen. It was no longer working for him.
And this is where it gets really scary. And we see how much more dangerous that folly is today. For Buffett, his house was about 10% of his net worth, okay? But for most first-time buyers now, a house can be 500% of their net worth, all financed with debt. The risk has just exploded.
Okay, but I can hear you thinking it. The big question, the one everyone brings up. What about appreciation? We all have that story, right? A parent or a grandparent whose house just exploded in value. Let's dig into that.
And you know what? The answer is yes. They absolutely have. The numbers on paper, they look incredible. But those numbers are hiding a much, much bigger story about the very money we use to buy those houses.
See, to really get it, you have to look at the money itself. Before 1971, the US dollar was backed by actual physical gold. But after we broke that link, our money just became, well, it became backed by faith. And the result of that has been decades of massive, non-stop inflation. It's like this hidden tax that's always eating away at your money's real power. So when you see a house price go up, what you're often really seeing is the value of the dollar going down. The price tag is bigger, sure, but the real value, well, after you factor in all the interest and taxes and maintenance, it probably hasn't grown nearly as much as you think.
And this all brings us to a really deep psychological point. Our whole idea of what it means to be wealthy is usually tied to things we can see, and that's a problem.
Real wealth is the money that isn't spent. It's the investments working for you in that compounding machine, quietly growing in the background. It's financial freedom. It's control over your own time. We're just so wired to think a big house equals success, but that might be the most dangerous financial illusion out there.
So try this little mental flip. Next time you see a giant home, you might be looking at someone who is house poor. They've traded their most valuable currency, not dollars, but their time and their freedom, for a pile of bricks and wood. They are often trapped in a job they need just to afford the thing.
So what's the alternative path? Let's look at the story of a guy we'll call Tom. Instead of buying a house, he rented and he lived frugally. He took every extra dollar he had and plowed it into investments, just letting that compounding machine do its thing. And the result? He bought back 14 years of his life. He retired at 43 instead of 57. He understood that owning your time is the real prize.
So where does all this leave us? Is buying a home always a terrible idea? No, not at all. But we have to fundamentally change how we think about it. Look, a home provides shelter.
It creates stability. It's a place to raise a family. These are incredibly valuable human needs, no question. But we have got to stop confusing these emotional needs with a sound financial investment strategy. A home's primary value is emotional and practical, not financial.
A truly intelligent investor, like Benjamin Graham taught us, always insists on a margin of safety. They look for assets that actually produce value, that put money in their pocket. And as we've seen, a primary residence just doesn't meet that standard most of the time.
The pressure to buy a house, it's immense. It's a powerful herd mentality. But your biggest financial decisions should never, ever be based on what everyone else is doing. You have to do the math, understand the real costs, and think for yourself.
At the end of the day, it really comes down to this one single, powerful question. Once you decide what your most valuable asset truly is, all of your financial priorities will snap into crystal clear focus. What is it that you're really working for?